So in the last few weeks, it was horrendous. The market suddenly crashed significantly and it had a V-shaped recovery. So in this video, I'm going to go through what happened, how you should think about it, and what you should do when there's a flash crash. So what is the last 5 years of the weekly chart for S&P 500? In 2024, the most recent year, there was a sudden drop here in April, and then in the last 2 weeks there was a larger drop. If you have never seen this chart before, these are the indicators I use in Investing Accelerator, which mainly consists of a Bollinger Band, 2 moving averages, and I also have these custom indicators that color based on the momentum. So green means good, red means bad, and the white and the black ones are usually the turning point candle. And then below is pretty much the same color except in a more graphical form, which is called relative strength index. So let me just move myself to the left. So here you can see that in the mid-end of July, the market started to correct. Now at this point, it was the earnings season and a lot of tech companies are going down. So when it comes to investing, I usually like to avoid the earnings seasons because it's very unpredictable, and hedge funds use a lot of money to try to predict earnings so then they can make a lot of money. So as an average investor, I don't really think myself or anyone have a very strong advantage to beat the hedge funds when it comes to earnings, unless you have some observation from your personal work. So then after such a rally, the big techs start correcting, which caused S&P 500 to correct as well. And then afterwards, Japan suddenly raised interest rates, which surprised a lot of the analysts in Wall Street and caused the market to further crash. And during this week, right after July and before August 12th, Warren Buffett also sold 50% of his stake in Apple, and that caused further panic, and it dropped significantly during the weekend and opened a lot lower. So it went from 553 for SPY here down to 510. And at that point, people start buying in. And then for the next 10 days, it was very bullish and went up all the way to 554. To be honest, as an investor, these are the discounted opportunities you're waiting for, where suddenly crash below and you know that we're not in a market crash situation, so it becomes a good opportunity to buy. But the reality is, for this specific bottom, it's actually very difficult to catch it because the time in which the stock price was down at 551 was actually just the first hour of Monday, and then it started to bounce back. So let me show you what I mean. So if I go to here, and I go down to the hourly chart, and I zoom out a little, then what you will find is that on Friday, the market closing price, the Friday closing price for S&P 500 is here. And then it opened a lot lower, which surprised everybody. And then the market started to go up, and it never came back down. You see? So if you are trying to catch the absolute bottom, you had less than 1 hour to do on Monday. So when it comes to investing, I don't think your goal is to catch the absolute bottom, but instead, your goal should be to enter at an average price. So instead, what we do is, let me just zoom back in again. We took some profit here before the earnings seasons because it was high, and then as the price is coming back down, we start adding back in. Now we don't add in all at the same time because it's almost impossible to catch the absolute bottom. So instead, we just want to enter in the middle of this area. So if you look at these two blue lines, they are the Bollinger Band, which stands for 2 standard deviation of the stock price in the last 20 weeks. So if you look at the middle part, that is usually a decent price to get into for S&P 500. If you can get close to the bottom line, that's even better. As a beginner investor, I think the middle part is good enough. So you want to enter over multiple weeks. And with the current macroeconomic situation, I think the bottom will take a little bit more time to form. The market will probably be choppy, meaning it will go up and down for the next couple of weeks. So the best way for you to get a decent average price is simply to invest for multiple weeks incrementally. So for example, let's say you had some cash aside, let's say 30%, and then you see the market dropping for 3-4 weeks, and you think a rebound is going to happen soon. So then from this point onward, you would be buying incrementally for, let's say, 6 weeks. So that is actually the plan we are executing in Investing Accelerator. And you already would have a list of stocks that you want to buy in, and you know they're at a discounted price. So then it makes it very easy and more mechanical when it comes to investing, and you wouldn't be as emotional when it comes to investing. So then that shifts your focus away from trying to catch the absolute bottom, but instead you're looking at the bigger picture and trying to get a decent discounted average price, and then afterwards you can hold for the next rally until the momentum slows down again. So basically the next time you see the green candle turning black and white. Okay, so that is pretty much how I analyze the V-shaped recovery